Hello and welcome to this video. In this video, I am going to describe money and the financial system. Money and the financial system are intertwined and cannot be separated. They both influence and affect the whole economy, such as inflation rate, business cycles, and interest rates. Consequently, consumers, investors, savers, and government officials would make better informed decisions if they understood how the financial markets and money supply influence the economy. A financial market could occupy a physical location like the Islamabad Stock Exchange, where buyers and sellers come face to face. Or it can be a market like Nasdaq, where computer networks connect buyers and sellers together. A financial institution links the savers and borrowers, with the most common being the commercial banks. For example, if you deposited 1,000 in your savings account, subsequently the bank could lend this 1,000 to a borrower. Then the borrower pays the interest to the bank. In turn, bank would pay interest to the savers. Bank's profit reflects the difference between the interest rate charged to the borrower and the interest rate the bank pays to the savers for their savings account. A bank, being a financial institution, provides three benefits to the depositor. First, a bank collects information about borrowers and lends to borrowers with a low chance of defaulting on their loans. Second, the bank reduces your investment risk. And finally, a bank deposit has a liquidity. If people have an emergency and need money from their bank deposits, they can easily convert the bank deposit into cash quickly. Every country uses the money. Therefore, every country has a government institution that measures and influences the money supply. This institution is called the central bank. Central bank influences three key variables in the economy. Number first is the interest rates. Interest rates reflect the cost of borrowing money. As the central bank expands the money supply, the interest rates fall, and vice versa. Number second is the business cycle. A business cycle means the economy is experiencing strong economic growth. Number third is the inflation. Inflation is a sustained rise in the average prices for goods and services of an economy. When a central bank increases the money supply, it can create inflation. Or when a central bank decreases the money supply, it can reduce the inflation rate. Without money, the buyers would exchange goods with the sellers by exchanging one good for another good, which is called as a barter. Unfortunately, barter has many problems. Number first problem is barter suffers from a double coincidence of wants. For example, if you produce shoes and want to drink a Coca-Cola, then you search for a person who produces Coca-Cola and needs shoes. Thus, you need to search for a person who wants the opposite of you, which could take a long time. Number second problem is many goods like fruits and vegetables deteriorate and rot over time. Growers of perishable goods could not store their purchasing power. They would need to exchange their product for goods that would not perish quickly if they want to save. Number third problem is that product and services do not have a common measurement for the prices. Number fourth problem is that business people would have trouble writing contracts for future payments of the goods and services under a barter system. And that's why a barter society would produce a limited number of goods and services. Money eliminates many problems with the barter and has four functions. First function of the money is a medium of exchange, because people use money to pay for goods and services and repay debts. Medium of exchange functions promotes efficiency and specialization. Second function of money is a unit of account. Money conveniently allows people to place specific values on goods and services. Thus, customers can compare product prices easily. Third function of the money is a store of value. Money must retain its value. Fourth and final function of the money is a standard of deferred payment. Money needs 6 desirable properties for people and businesses to use money. It must be acceptable. Number second is a standardized quality. Number third is it must be durable. Number fifth quality is value relative to its weight. Number fifth is it must be divisible. Public can break money down into smaller units to purchase inexpensive goods and services. People since the dawn of civilization created payment systems. First and oldest payment system is commodity money. Government selects one commodity from society to become money, such as gold or silver. Commodity money could be the full-bodied money. Second form of commodity money is representative full-bodied money. This money has little inherent value. Governments and central banks created the second payment system, which is fiat money, and it is a 20th century creation. Most central banks in the world today use fiat money. Third payment system is a check. A check is credit money tied to a person's checking account. Economists use two approaches in defining the money supply: transaction and the liquidity. In transaction approach, they emphasize the money's function as a medium of exchange. Only a few assets possess this property. If the economists use the liquidity approach, they take all the assets, rank them by liquidity, and include only liquid assets in the money supply. Economists define the M1 as the narrowest definition of money supply because they use the transaction approach to determine which financial instruments to include. M1 adds the currency held by the public and in the bank vaults. It excludes currency held by the government. All forms of checking accounts, travelers' checks that are held by people and not by the banks. Economists define the M2 as a broader definition than M1 because they use the liquidity approach to define the money supply. M2 includes everything in M1 and also includes all small denomination savings, deposits, and time accounts at all financial institutions. Economists define M3 broader than M2 and it includes everything from M2 and also include large denomination savings and time deposits and time accounts and liquid securities with longer investment times than the financial instruments included in M2. Economists define L for liquidity as the broadest measure of the money supply and include all liquid assets. It includes everything from M3 and also it includes all short-term securities such as treasury bills issued by the US federal government. So that was all about in today's video. I hope you find it helpful. Please don't forget to subscribe my YouTube channel and also like and comment on my videos so that I can improve my content. Thank you for watching.